Hey everyone, welcome back to the channel. Today I want to ask you a philosophical question that's going to completely change how you think about investing. Which one came first? Was it the chicken or was it the egg? Now, before you click away thinking this is a philosophical lecture, stick with me because we're not talking about chickens and eggs. We're talking about property and business. Which one came first, and more importantly, why does it even matter? Now, by the end of this video, you're going to understand how these two seemingly completely different asset classes are actually two sides of the same coin, and how mastering one automatically gives you the skills in the other. Now, if you're interested in property investment or business growth or creative deal making, make sure you hit that subscribe button because this is going to open your eyes to opportunities you've probably never really considered. Now, my name is Richard and welcome to Ron's Industries, the industry blog for investors where we're pro-wealth, pro-growth and pro-real estate. Now let's dive in. So let's start with how many people think about property and business. On the surface, they seem completely different. But when it comes to property, the traditional path is pretty straightforward. You either rent, or if you're buying, you save up a deposit, you go to the bank, you prove that you can service a mortgage, and if everything checks out, you get your loan. Pretty standard stuff in that scheme of things. Now, business financing follows a similar pattern, but with some key differences. You're still going to a bank, you're still proving that you can repay, but now you're dealing with commercial loan rates. The terms are going to be different depending on how your business model, your cash flow projections, and what you're planning to do with that money. And like everything, this is where I say it gets interesting. If that loan is for an investment purpose, you'll probably need to put up additional security. Why is that? Because there's no guaranteed cash flow. The bank needs protection in case things don't work out as planned. So we've got two different asset classes operating within their own lanes with different rules and different structures. Now, most people look at this and think property is property and business is business. And those two, they don't meet in the middle. But here's the thing, they couldn't be more wrong. Now, despite all these apparent differences, different asset classes, different lending structures, different risk profiles, the truth is this. You can learn a tremendous amount about one by studying the other. And this becomes crystal clear when you start looking at creative financing and deal structures. You see, getting a loan and repaying a mortgage isn't the only way to acquire property. Just like in the stock market where you can get started with minimal capital or trade derivatives with different risk profiles, you can get into property in multiple ways. Now, the same applies to business. It's not always about traditional loans and mortgages. And this is where property and business truly converge. In the world of private money and private equity, this is where the magic happens. This is where the most sophisticated deals in both property and in business actually get done. Now, let me explain why this is so powerful. Now, when it comes to private equity deals, everything changes. The terms, the agreements, the structures, it's all negotiated between the parties involved. Now, these are legal agreements, whether they're joint ventures, investor partnerships, or any other structure that define the roles, returns, terms, and responsibilities of the deal. Now, here's why this matters and why it's so different from traditional bank financing. Let's say you've got an innovative business idea. Maybe it's a new technology or a unique product or an unconventional approach to solving some sort of real-world problem. If you go to the bank and they say, look, this is interesting, but it's unproven. We don't understand the technology. Our risk profile doesn't allow us to take this type of chance. If you fail, we need to protect our money. Sorry, but we can't help, we're out. Now, when it comes to small-time entrepreneurs and inventors, this is probably the type of thing that happens more often than we think. Banks are conservative institutions, and they need to be. They need predictable returns and secure collateral. Anything outside of their established parameters is probably going to get rejected. Think about wind energy projects, for example. They often require price floors and guarantees to secure traditional financing. Banks like certainty. In fact, based on the amount of money that they control, they need it. But private equity, that's a completely different game. Private equity operates outside of fixed institutional constraints. It involves individual investors, companies, or other legal entities, other joint ventures even, who can make decisions based on different criteria. So when someone presents that same innovative widget idea to the private equity investors, the conversation can potentially change completely. They might say, you know what? We might not understand every technical detail of this product, but we can see the big picture. We understand that there is an opportunity out there in the market, and we believe in what you've set up. So we're going to take a chance. So what will happen is that there's the potential there to form a joint venture, invest in that deal, and suddenly something that was impossible through traditional financing becomes a reality. Now, as I say in almost all of the videos that I've made so far, this is where it gets interesting for property investors. The exact same principles apply to real estate. Property joint ventures are structures where investors form partnerships and create deals with other parties who bring something valuable to the table that they might not have. Maybe one party brings knowledge where they understand the local market, they know how to navigate planning permissions, they have development expertise. Another party might bring the ability to do the actual work, project management, construction contacts, renovation skills. Someone else might bring the funding, the capital to make the deal happen. And here's the beautiful part. There's nothing that says a joint venture requires a specific structure or a certain amount of parties. Now, this is where property and business strategically and financially collide. They can have deals between buyers and sellers, investors and sellers, multiple investors in different combinations. The possibilities are virtually limitless. It's all about who's involved and what gets negotiated, what gets agreed upon, and making sure that everyone has clear exit strategies if things don't go according to plan. Think about it. You could partner with someone who owns a property but lacks the development capital. You could provide funding, they provide the asset. You split the profits based on the agreed terms. Or maybe you find a great opportunity but lack the local knowledge. You partner with someone who understands the market intimately. They navigate the deal, you provide the capital and project management. So the structures are limited only by imagination and what the parties can agree on. This is the power of private money in property, the same power that exists in business deals. No rigid templates, no one-size-fits-all approach, just creative problem solving and mutual benefit like all good business. Now, before everyone rushes out to start structuring joint ventures, we need to talk about something absolutely critical here, and that's due diligence. And when I talk about due diligence, this is where I've said in previous videos that smart money knows things. Now, this flexibility and creativity comes with responsibility, and I'm talking serious responsibility. Whether you're getting into property or business, whether or not you're investing in someone else's company or having someone invest in yours, whether you're selling equity for cash or entering a development partnership, you absolutely must know what you're getting into and what your responsibilities are. So you need to understand the following. You need to understand what's at stake. You need to know what the costs are, what the risk profile looks like, what happens if things go wrong, who's responsible for what, and how the returns are calculated and distributed. And above all, you need to know what the exit strategies are, not just at the end, but what happens along the way. No one, and I mean absolutely no one, should be getting into any sort of deal, let alone a joint venture, without complete understanding of what's happening. Now, everyone involved must have complete transparency about their roles, their responsibilities, returns, terms, and contingency plans. This is absolutely not optional. This is fundamental. So before we move on, none of what I'm saying here is commercial or legal advice. You need to make sure you're getting legal advice. Get financial advice. Do your homework. Understand every clause in every agreement and make sure you've got a good team around you. The flexibility of private equity is powerful, but it demands rigorous due diligence from every participant. All right, so we've covered how property and business intersect through private equity and joint ventures. But here's the real game changer. Here's the insight that makes all of this so valuable. Skills developed in one asset class transfer directly to the other. Think about that for a moment. When you learn about how to structure a business partnership, you're simultaneously learning how to structure a property joint venture. When you master creative property financing, you're gaining insight into business equity arrangements. And to that end, these following principles are universal. Skills such as negotiation, risk assessment, partner selection, deal structuring, value creation, as well as exit planning. All of these skills apply whether you're doing a business deal or whether you're doing a property deal. And this is what creates what I call the multiplier effect on your investment education. You're not just learning about property, you're not just learning about business. You're learning about deal making. You're learning about value creation and strategic partnerships that apply across every investment category. So study business partnerships deeply, and you're simultaneously building expertise in property development structures. Master creative property financing, and you've developed skills that translate directly to business equity arrangements. It's like getting two educations for the price of one. So to answer our original question, which one came first? Was it property or was it business? The truth is this, it really doesn't matter. They're not separate worlds. They're two expressions of the same fundamental principle of investment, negotiation, and value creation. Both rely on creative deal structures, private capital, and joint ventures to unlock opportunities that traditional financing simply can't accommodate, or just won't. For anyone watching this who's interested in building wealth, whether you're an entrepreneur seeking capital, an investor diversifying your portfolio, or a property professional exploring development opportunities, understanding this convergence opens up exponential possibilities. The skills you develop in one arena automatically strengthen your capabilities in another. So don't think of property and business as separate paths. Think of them as complementary skill sets that multiply your potential for success. So if you found this valuable, smash that like button and subscribe for more content on creative investing, deal structuring, and wealth building. Drop a comment below and let me know, are you more focused on property or business right now? And have you considered how the skills from one could accelerate your success in the other? Thanks for watching. I'm going to see you in the next one.